we're looking at how buy now, pay later companies play into this year's holiday shopping. For more, we're bringing in David Chiaverini, Managing Director of Equity Research at Wedbush Securities. David, it's good to see you. Apparently, Adobe is looking at $18.5 billion in holiday spending finance with buy now, pay later. It's a little bit of an uptick from last year. What do you think here? How important a part of the financial system is buy now, pay later at this point?
Yeah, it's still a very small share of overall, retail sales. Right now, BNPL is a high single-digit share of e-commerce spending, and e-commerce spending is a mid to high teen share of overall retail sales. So BNPL is still a relatively small share, but with that said, the growth is very much higher than the overall sales growth. So I think the outlook for BNPL providers is favorable here.
So when Dave, a lot of viewers listening right now, when they think BNPL, they think Affirm, but you're on the sidelines on that name, David. Why are you on the sidelines? What does Max Levchin have to do to get you more bullish on his company?
Yeah, so what's keeping me on the sidelines is the valuation. Now, fundamentals are trending in the right direction, but a valuation perspective, it's trading at about 8 times EV to sales, which for us is on the expensive side. But I have to give them credit that credit quality has been better than expected. Growth has been very strong, and we are expecting continued strong growth over the next few years. So if we were to see a dip in the stock, that could get me off the sidelines.
Well, and it's interesting that you mentioned the credit quality piece, because one might, at first glance, look at these companies and think, well, they're lower quality borrowers, maybe there's higher default rates among them. How do you approach, or what do you think of Affirm's modeling and maybe some of the peers of the industry more broadly as well?
Yeah, I've been pleasantly surprised with the level of credit losses that they've had over the past few years, because you're absolutely right. They target kind of middle America. So when you think of the FICO spectrum, they are right in the middle. Think, near prime, subprime type of borrowers. But their underwriting has been very strong. Their modeling has been spot on. They're looking at kind of low single digit type of loss rates when you look at the loss rates on a trailing 3-quarter GMV basis. And I would have expected that to be higher. So they're keeping that in check. And I think that they're going to look to actually expand their underwriting standards, given that they've kept their margin in a decent place. For instance, their revenue less transaction costs margin, they want to keep that in a 3 to 4% range. They're at the upper end of that range. And now with the outlook for lower interest rates, it could take them above that range, all else being equal, but they're going to loosen underwriting standards and be willing to take on more losses to generate more GMV growth.
David, another name I want to get your take on, because you only have one underperform in your coverage universe, David. It's just one lonely cell sitting there, and that is SoFi, which has enjoyed, it's a nice move this year. It's up around 60%. Why do you remain bearish on SoFi, David?
Yeah, so SoFi, that's our paired trade with LendingClub, and LendingClub has actually outperformed SoFi when you look at the year-to-date figures. So when you look at the business model of SoFi versus LendingClub, they're actually quite similar in terms of the FICO range that they are targeting for borrowers, and the credit quality has been similar. But when you look at the valuation discrepancy between LendingClub and SoFi, it's too wide to ignore. So that's when I keep the underperform on SoFi and keep the outperform on LendingClub. But I'll give SoFi credit that they have been right in the sweet spot of this kind of FinTech rebound that we've seen this year, and they've been benefiting. But if it weren't for their valuation discrepancy with LendingClub, we would be more favorable towards SoFi.
David, you cover the broader financial universe as well, and I'm curious, when you look at the FinTechs versus what some folks call TradFi, right? Traditional finance, with rates going down, but maybe not going down as much as had been expected, which of those segments sort of stands to gain or conversely be hurt the most by the current trajectory for rates?
Yeah, so good question. When looking at the traditional banks that I cover, given the forward curve has shifted around a lot this year, and Recently, it looks like with tariffs and the potential for inflation that the forward curve, as you noted, may not go down quite as much as originally thought. So that should benefit some of the asset sensitive names in our coverage. So First Citizens, FCNCA should be a beneficiary there, as well as First Horizon, FHN, and then Zion's Bancorp, ZION. They should also benefit in this forward curve environment. And if it doesn't shift lower like it had looked just a few months ago.
David, good to see you and good to see you on the show. Thank you.
Thank you. My pleasure.